LMI, or lender's mortgage insurance, is something I believe we've all come across at one stage or another during our life, either through the media, friends and family, or simply just through the home loan application process. In this video, I'll unveil what LMI is, how you can calculate it roughly, what companies are involved, as well as how you can waive the LMI. So stay tuned till the end of this video and I promise it'll be insightful. Just before we go further into the video, welcome to my channel. My name is Mihir. I upload educational content such as this. So if you're interested in content like this, please make sure to hit like and hit subscribe. But without further ado, let's get straight into the video. LMI is a one-off fee you pay to your lender for borrowing above 80% LVR. LVR simply means loan to value ratio, and now I'll paint you a scenario just to further explain that. So let's say you're in the market to buy a $400,000 property and you have a 10% deposit of 40k. As you have 40k and you need to buy a property 400k, that means you minus 400k with 40k, meaning you're left with 360k, which you need to cover via the loan from the bank. The easiest way to calculate LVR is simply to just divide the loan amount, in this case $360,000, with the property value. And there's no deposit or anything included. So just loan amount divided by the property value times 100. In this case, that would be a 90% LVR. But if you just want a quick way to work out this calculation, which is quite simple, all you have to do is just look at the deposit and just do an inverse. 400k, 10% of that is 40k. So the 90k must be subsidized as a loan, meaning the loan to value ratio is 90%. There are many nuances to doing it, but this is one of the simplest way to calculate it. A common misconception that I see amongst people on Reddit or just general people is that they hear the word insurance, so they think lender's mortgage insurance. They believe the insurance is for them, that it's actually a beneficial thing, that the premium they're paying is actually good for them. But actually it's not, it's for the lender. So LMI, the whole purpose of it is to protect the lender from you in case you default on your loan repayments. Hence why lender's mortgage insurance is lender's mortgage insurance, not the actual person getting the loan. And that's quite an important distinction to make because it's your money you're putting down on the line. So now let's get into the numbers, shall we? The calculator I'm using is from Genworth Financial. Genworth Financial is coincidentally one of the two main mortgage insurers here in Australia that dominate the LMI market. Financial institutions such as CBA utilize them. I'll leave a link in the description so you can check it out yourself, but now I'll just add the scenario we had previously into this calculator. Now let's play the above scenario mentioned. So the property value is 400k, the deposit is 40k. In this case, I'll tick yes for first time buyer. The loan term is up to 30 years and the occupancy is going to be owner occupied. So let's calculate that. If we calculate that, we get a value of 6,943 upfront LMI premium, which isn't too bad necessarily considering you're saving like 40k if you were to go like full on without the loan, which is not too bad at all. Obviously this calculator can be a good gauge as it's coming from one of the two main mortgage insurers in Australia. However, please use this with a grain of salt. It's just a good gauge. It's much better if you consult with your lender further on, but this can still be a good gauge. The example I just showed to you from the Genworth calculator with the 400k property, you can see that there's an upfront LMI and there's a monthly LMI premium. However, there's another sort of, it's the same sort of thing as LMI, but lenders are a bit cheeky. What they do is they sometimes add the LMI premium into the total loan. So with that same scenario I mentioned before, the 400k property and the 360k loan, instead of 360k, they would add that loan with the LMI premium. So in this case, the LMI premium, according to this calculator roughly, was 6,400. So that means that 6,400 will be added to the total outstanding loan. So instead of 360, it will be 360k, meaning that the total loan amount is increased and the total interest over time is increased, as well as minimum monthly repayments. So that's something guys got to keep a lookout for. But you still save that 40k if you weren't going to take this route. And sometimes if you're an investor, like most of the times you're an investor, it makes sense to sometimes get the LMI just to get into the market. But that's a whole nother video. But I'll now move on. Besides Genworth Financial and QBE, which are the two main dominating mortgage insurers in the Australian financial space, there are several others similar to this, but actually owned by lenders, and they don't have an LMI. It's the same concept, but it's just called something else, slightly different. So there's things like a deposit premium, and they charge fees, but they call them risk fees. There's loan extension fees. There's a reduced equity fee. But in the end, they're pretty much the same, if not very similar to LMI. And obviously, please do your research on that. Don't listen to some guy on the internet, but they're quite similar. And they're actually owned by the lenders. The company's actually done by the lenders themselves, which is interesting. Now, a question or a concern that I commonly see amongst people on like the internet or Reddit just generally is that, can I pick my LMI provider? The short answer is no. So what happens is whatever lender you go to, whether that be CBA, NAB, or one of the smaller banks, they have an exclusive sort of deal with either one or two mortgage insurers. So there's not much flexibility, but it shouldn't matter either way, regardless of that. Let's get into the nitty gritty. So you may be wondering, okay, Mihir, you've covered everything. You've touched base on what it is, how to calculate it, what companies are involved, but how do you actually avoid it? The way you avoid LMI is through a couple of ways, but it depends on your eligibility and criterion to meet these conditions. The first way you can avoid this is by going through a scheme, such as the First Home Loan Deposit Scheme, where all you need is a 5% deposit, and then the government and the bank they cover the 95%. So pretty much that's one way, but there's limited spots in that. There's like around, I think 10,000 or so, don't quote me on that, but there's a few spots, and it's only available to people such as citizens. So there's a lot of criterions in that. I've also made a video on that, talking a bit about that. So what I'll do is I'll leave a link to that in the description, or the eye icon. The next main way you can do this or avoid LMI is through having an exemption based on your profession. So some professions such as doctors and other medical professions, or accountants, actuaries, they can actually get like LMI waivers or some other form of discount on their loan, which you wouldn't get elsewhere because of that profession. It depends on lender to lender, because some banks are more friendly to maybe like defense or federal police, but there's no way you can do with that. So what I'd suggest you do is obviously contact a couple of mortgage brokers and see your options. But like I said, I was saying like sort of high profile professions just now, like actuaries, doctors and stuff, but this isn't only exclusive to them. It can even be to nurses, federal police, so like the Victoria Police, defense, so ADF members. It just depends on who your lender is. So just consult with a mortgage broker and they'll find you a way. Third way you can avoid LMI is to simply get a guarantor. So a guarantor is someone who just guarantees that if you cannot pay the loan, that the guarantor will cover it. Sometimes you don't want to do a guarantor because let's say if you somehow can't pay it, then your parents or someone, whoever the guarantor is, they'll be forced to step up. But that is one way you can do it. And lastly, the final sort of main way you can do it is simply just paying below 80% LVR. There's some ways that banks, they can sometimes allow a bit like maybe 85% then above that LVR, but that's sort of a bit rarer nowadays. But like I stated again, consult a mortgage broker and do your due diligence online. Overall, I hope this video was educational and gave you a brief overview of this LMI space and provided you with a stepping stone into your own research and due diligence. If you like this video, please make sure to hit like and hit subscribe, as I'll be uploading videos such as this on a more frequent basis now. But if you also have any video suggestions or any other comments, any questions, please leave them down below. I'll be more than happy to answer them. But besides that, I hope all of you have a fabulous day. Thank you. Goodbye.